Hello, good evening, everyone. Welcome to our webinar this evening on retirement planning for financial independence. My name is Francis Innes. I am a board director and a member of the Education Committee. I'd like to take this opportunity to also welcome other members of the Education Committee, members of the board, management, and staff, our wonderful management and staff. Planning for your retirement is very important. And most of us would love to retire early. I would love to retire early, but it takes a lot of planning, a lot of sacrifice, and we must take care of ourselves. We must take care of our health to enjoy those older years. Some people say planning for retirement starts from your first paycheck. Some people say they plan at 40, but a lot of people start planning even earlier now, even with the kids. So I know it is always important for us to plan, have that sacrifice, but also remember, as a member of your credit union, please remember me, Cannons Employees Credit Union, is your first destination and your financial needs, and give us the lion's share of your business. We are here to support you. Ladies and gentlemen, it's from this perspective that we have organized today's session. At this time, let me remind you of a few of our house rules. Please ensure your mic is muted throughout the session. If any questions come to mind during the session, you can place it in the chat box and we will respond to the question and answer segment at the end of the session. This webinar will last for 1 hour. It will be recorded and uploaded in the library section on SECU's website. Our presenter today is Keith Callender, a qualified and experienced financial services, special services for over 40 years. Keith is also a fellow of the Life Underwriter Training Council and a registered financial consultant with the International Association of Registered Financial Consultants. He began his career journey at the NIB, where he held various positions, the last being the Human Resources Officer and the Secretary to the Human Resources Subcommittee Board. Following this, Keith entered the insurance industry, where he has been serving for the past 30 years. He has also been the founder of Managing Director of KC Investment and Financial Services Limited, which provides sales management and personal financial planning services to individuals, small and micro enterprises. It also holds a certificate in personal financial planning at Reutech in collaboration with the Canadian Association for Insurance and Financial Advisors and management studies at our University of the West Indies. In addition, he's also a 28 years life member of the Million Dollar Roundtable, a global independent association of leading insurance and financial services professionals from more than 500 companies in over 70 nations and territories. Keith is passionate about his working with people to formulate, plan, and realize their personal and financial goals. He believes that his purpose in life is to make a difference in the lives of other people. He is a founding member of Destiny Credit Union Cooperative Society Limited and is the outgoing president after serving for 6 years. He's a devoted husband, proud father of 5 children and 2 grandchildren, and an avid sports fan. Let us now listen attentively as Keith presents how to achieve financial independence when planning to retirement. Keith, take it over.
Thank you very much, Mr. Innes, for that introduction. I want to thank the board and the Education Committee for giving me the opportunity to present this evening to the members on the whole topic of financial planning. So what I will do at this time, I will just share my screen, and without further ado, are you all seeing my screen? Just want to confirm.
Yes, we are, Keith.
Right. So without further ado, we're going to start our slideshow. And yes, we're going to move the curtains back and get the show on the road. So what we're going to be talking about today is we're going to have some specific objectives that we hope to achieve. One, we want to have an awareness of the changing retirement landscape, how things are changing, how it's going to probably how it's affecting us now or how it will affect us in the future. We're going to examine the importance of starting early. We're going to identify factors that hinders preparation. And then we are going to seek to understand the steps in the process. And somewhere along the way, I will really want to take the time for you to be able to assess where you are in terms of your own personal situation. And also to identify sources of retirement income and to distinguish between the different funding needs. So globally, population is aging, and you all may have not have you all may have heard that before. So for the first time in the history, people aged 65 and over are expected to outnumber children under the age of 5. And if we look on the screen at on the top chart, you would see the green line represents persons 65 years and over, and how that has steadily been increasing from since 1950 and projected up to 2050. And similarly, the blue line representing children under the age of 5 and how that has been decreasing. First, people age 65 and over are now the fastest growing portion of many nations. And these statistics are according to the US Department of Health and Human Services. And again, if we look at the chart below, we see where, if we look at the last two bars, the 85 plus and this 100 plus, you will see the substantial increases relative to the other two groups, which are those under 64 and those at 65. When we take a view of Latin American and the Caribbean population age 60 and over, again from a similar period of 1950 projected to 2050, notice how the line, again, the trend line has been increasing. And if we look and examine where we are in 2023 now, and if we look at the second to last bar to the right, which is showing 2025, and if we were to look at the vertical line to the right of the graph, at 15%, you would observe that second dot is just under that 15%. So which means the Latin America and the Caribbean region of persons 60 and over are hovering just under 15% of their population. Let's bring it home now to Trinidad and Tobago. In 1955, that's as far back as I was able to acquire, population of Trinidad was 720,000, and persons over age 60 was 40,000, representing 6% of the population. By the turn of the century, we were up at a population of 1.2, persons over 60, 126,000, representing 10% of the population. And by 2021, 1.3 million, 183,000, representing 13% of the population. So what does that say to us? It says that our population exists aging in Trinidad and Tobago. It is said by 2050, this can reach that 183,000 that we spoke about earlier, can grow to as much as 354,000 for persons over age 65. The age dependency ratio, which shows the number of persons age 65 and over for every 100 persons aged 15 to 64. So if we were to look at the bottom chart, we see in 1950, there was 7 persons for every 100 individuals in the population in Trinidad at age 65 and over. That grew to 9, 25 years after, it grew to 10, and it's projected that by 2025, it will be anywhere around 21 persons per 100. So it's clearly Trinidad and Tobago population is mirroring the rest of the world in that our population is aging. And if we were to take a look at this age pyramid, 1980, look at the top here, the person over 60, how narrow it was, but look what happened by 2011, how that has broadened at the top. So again, all evidence of aging population in Trinidad. So what happens now as a population ages and what drives population aging? Well, there are two major contributors. One, declining fertility and increasing life expectancy. So in Trinidad, we are expected to have a rate of 1.9 children per woman by 2021. Sorry, by 2050, down from 5.3 children per woman in 1950. Now, some of us, our parents, you would have heard your parents saying you have that their parents had 12 and 15 and 14 and 8 and 9 children. And now when I tell anybody I have 5 children, they say, what? They open up the eye. You have 5 children? What are you doing with 5 children? Because most people now, they want 1 or 2. So fertility rate has definitely declined. On the other hand, life expectancy among Trinidadians, 65 and over, is increasing. So this group, if we're talking about 2050, you are expected to live at least the next 19 years after you have retired at age 60. And this is according to the statistics that the demographers have projected. So we move along. So what's the implication of aging? As people live longer, retirement pension and other social benefits tend to extend over a longer period of time. You also have a situation of rising medical and healthcare costs and rising ratio of elderly 65 plus to the working population, and we just took a look at that. So why is it important to start saving early? I heard Mr. Ennis talk about, they said that you ought to start planning for your retirement from the first day you start to work. And I put this up as an illustration to highlight the advantage of starting early. And I have a twin, James Doe, one brother, and John Doe, the other brother. James decided he is going to start to save his money at age 18 years of age. And he will put aside $3,000 every year for 9 years. Assuming a rate of return of 8%, he would have accumulated $753,572 when he turned 65. All he would have contributed was $27,000. His brother, John, he decided he wanted to party and have a good time, Trinidadians youths. But 9 years after, he realized that his brother had $40,000 that he had accumulated. And he realized, but wait now, if I had done what my brother did and I have none, then maybe I should have followed my brother. And he decided he is going to follow his brother's example and starting to save $3,000 every month. And he did that until he turned 65. So let's just go back to both slides, to the previous slide. So John started late. He accumulated at age 65. Remember, they are twins. He accumulated 713,000. His brother, on the other hand, had accumulated 753,000. John contributed 114,000 over the years, and all James contributed was 27,000. That, ladies and gentlemen, demonstrates the power of compound interest and the importance of starting early. I'll move on. So what are some retirement risk factors that we face as we plan towards retirement? We have the issue that we have already touched on longevity, the fact that life expectancy is increasing, the prospect of possibly needing long-term care as a possibility, inflation, and inflation tends to have a ravaging effect on income. Liquidity, to what extent, if I need money, that the investment that I have, how liquid that they are, that if I really need to have a emergency situation, sorry, I could be able to quickly put my hand on cash. What about interest rates? What direction is interest rates going? Is interest rates going up? Is it interest going down? From now till my retirement, what has been the trend? And we can in Trinidad, primarily since 2008, interest rates have tended to trend downwards in most instances. What about business? Is the business that I'm in now, if I'm a business owner, is that still going to be viable then? I could have a business, but the whole market could change that impact upon my business. And then we talk about market risk. Market risk relates to the extent to which there could be potential changes in the market of itself, given fluctuation that could adversely affect financial investment that I have made. What about public policy changes? Government could come in office and change public policy. Right now, as an example, we are not taxed on investments. One time we used to be taxed on investment. We are no longer taxed on investments. What about health expenses? Can I expect either myself or my spouse or some other family member, we have some health challenges that there could be some incurring expenses along the way. Family relations, death of a family member or major illness of a spouse or a divorce or bad financial dealings of a spouse or unseen financial needs of other family members. Or I may be forced into retirement. Only this past week, I saw where a police man in Tobago is being forced into retirement. It was on the news because it was felt that because he has lost an arm, he's no longer useful to the service. He is saying otherwise. So what are the factors that actually hinder preparation for retirement now? These are the tendency to spend all our income. Unexpected expenses. At times as well, the inadequacy of insurance coverage. For instance, I heard of extensive flooding on Rice Road today. If there's a major storm that hits Trinidad and Tobago, we haven't had one since Tobago in 1966 or thereabout. And people have a way of saying, God is that Trini, so nothing will happen to us. But nevertheless, if should something happen, is my home that I have that I make a sacrifice for, which in most instances for a lot of people represent their largest single asset. Is it adequately insured? Do I have insurance at work that I partake in? Do I have life insurance in the event that if a spouse dies, that the remaining there's money that is going to come in if the couple had a mortgage to pay off the mortgage? We have issues of divorce. How does divorce affect a person's employer plan for retirement? All along things going nice, and then all of a sudden, two parties go separate ways. Marital properties have to be shared up. Wife probably gone with the home. And you know, if you are this husband, you have to fend on your own and start life all over again. Or what about no employer pension plans available? Also, the issue of frequent employment changes or simple lack of financial literacy or other accumulation needs that may occur from time to time. So let's take the time to stop and examine what are some of the steps in this process. Where to begin? We begin by starting to establish what what are your retirement objectives. And in another slide, I'll delve some more into that. Develop your personal financial statement. That is what you own and what I owe, who I owe. And we will also examine a slide on that in a while. Develop an income and expenditure statement, which is simply a budget. Identify the resources that are available for investments. What resources do I have that are now not being properly utilized to give me the best investment returns down the road? So sometimes we really need to step back and look at ourselves, look at what we are doing, and the personal financial statement helps in that regard. We need to take a critical view of where you are relative to the retirement goals that you want to have established for yourself. And when you would have done that, then you will be in a position to know whether or not the investment that I have are being underutilized, and if I should make certain changes to my investment portfolio to be able to realize the goals that I want to achieve for my retirement. What will be an example of that? Just giving a brief example. A person may have 75,000 sitting down in a bank account, earning 0.01% interest on it. Could they use that 75,000, put some of it to the credit union, take a loan from the credit union to buy a piece of land for maybe 150 to 200,000? And they have that land earmarked as, because land no rotten, land primarily appreciates in value, so that they have this piece of land as part of their retirement plan. So you are paying back the credit union. So the credit union is benefiting. You are benefiting as a member of the credit union. And as a part of your long-term plan for your retirement, this land could be sold 20 years down the road, 25 years down the road, but sometimes up to 10 times the value you paid for it. So just an idea in terms of what you can do. And obviously, once you have identified your objectives, you have to take a critical look at what your financial position is at the point in time in terms of everything that you have owed. When you have examined the income and the expenditures, and you want to always be in a situation where you have a disposable, a residue income, you look and examine to see if the income the expenses, sorry, that you have outlined, how much of that expense is geared towards your retirement. For instance, do I have an employer pension plan at work that I'm contributing towards? As one example. Do do I have an individual pension plan that I'm contributing towards? As an example. And once you have identified all your resources, you develop your plan, and don't just have your plan developed, because a developed plan without implementation amounts to nothing. And as you go along through life, You monitor the progress that you are making from time to time. And it's advisable that you stop maybe just once a year, once every other year, and you take a critical view of your situation. So let's talk a bit about what are some of the factors that we could consider in setting those retirement objectives that I spoke about earlier. When do I want to retire? So look at your age now. You may be 25, 30, 35. And you think of, when do I want to retire? Do I want to retire at 60? Do I want to retire at 65? Do I want to retire at 50, at 55? Think of that date that you have in mind. And once you have identified that date, let's say, for instance, if you use 60 and you are 35 years of age now, and you have not started before, or even if you have started, the amount of time that you have to prepare is basically 25 years, which is referred to as your retirement preparation period. Then we look at how much money will I need to fund my retirement lifestyle. Should I retire earlier with less income, or should I delay retirement so that I can increase my standard of living in retirement? And I remember having a case with a client many years ago. She said, "Keith, I want to retire when I'm 60 years of age." She was 55 at the time. And after I had gone through her personal financial statement, we looked at her budget and the like, I turned and I said to her, "This is your financial situation right now. You tell me, do you think it is still possible for you to retire at 60? She could not. In fact, she did not stop working until she was 68 years of age because she simply, the lifestyle that she wanted to have, she had to make that added sacrifice of time to be able to enjoy it. And I might just take on to the other question. Am I willing to take a trade-off between maintaining my current lifestyle and working towards achieving my retirement objectives? And these are these questions that we have to ask ourselves as we sit down to plan and set objectives for your retirement. And in setting those objectives for retirement, you should be ideally clear. I want to retire at age 60 or 65, whatever age that you have determined, with an income of X number of dollars. Right? Now, it is said that generally an individual requires between 70 to 80% of pre-retirement income as income in their retirement, just that they could continue to maintain the lifestyle that they have gotten themselves accustomed to over the years. So let's look at what you can do, and this is an exercise you can do for yourself. Personal financial statement, what I own. And you're taking a look at the money that you have in the bank, your mutual funds, money that you have in cash, value of insurance, pension plan, your annuity, stocks and shares. And when I say stock shares, you also include your the credit union, real estate, your home market value, your vehicles, other assets, any and everything that you own, put a financial value to it. Then you want to look at what I owe. Do I have a mortgage loan? Do I have a motor vehicle loan? What are the balances? Credit card, what are the balances? Hire purchase, what are the balances? Other loans, what are the balances? Because what you want to get to is, what is my net worth? Your net worth is the true value of who you are. And what needs to be done over time is working towards increasing your net value or net worth, over time. So your three main variables in your retirement plan, your age at retirement that you want to retire, the kind of income that you have available for retirement, and the annual amount you have saved, or that must be saved to provide that income that you want. And we are going to take a look in a while at some of the other variables. So what are some of the factors that affect a person's need for retirement funding? Estimated living needs during retirement. It's expected that a person who probably would have retired, one of their expenses that hopefully would drop off if you had a mortgage, hopefully by the time you retire, you want to have that mortgage payment cease. So that amount of money that you were paying and contributing on a monthly basis towards the full acquisition of your home will come to an end that you could have paid off your mortgage by the time you retire. I have seen people retire and going and taking loans, refinancing their home just to have a nice, lavish house. And they end up being very house rich, but cash poor. Don't allow yourself to find it in a situation like that. Anticipated income from your company pension plan, annuities or rent or investment or business. And what is the current value of your retirement assets and other investment that might be used to provide an income? So again, what I would want, at the ending of this seminar, when you go on your own, go and take a look at, if the company that you have, they have a pension plan and they give annual statements, be interested in what your statement is and help and monitor the change taking place from year to year. And whether or not where you are, the amount of money that you have accumulated in your pension plan is adequate enough to provide you with the kind of income that you want to have when you retire. And what is the remaining time until retirement, which we refer to as your retirement preparation period, to move from your current lifestyle to your retirement lifestyle. You also have the amount currently being saved towards your retirement. Am I saving enough money on a monthly basis or a quarterly basis or an annual basis towards my retirement? The life expectancy of the individual and his spouse. Some people, because of family line, they tend to have shortened life expectancy. Nobody in your family line live beyond 70 years of age. Other people, because of family history, grandmother, great-grandmother, everyone living in 90s or beyond. So that if you know that you, your particular bloodline or that of your spouse, what might be reasonable, notwithstanding the statistic that I shared earlier. And then we have pre and post budget retirement inflation rates. What is happening to inflation rates? How is that? Inflation is the biggest factor that affects retirees. Because in Trinidad and Tobago, most pension plans are level. By level, I mean they are not indexed for inflation. So if I start getting a pension and my pension is, let's say, $6,000 a month, which is a flat pension, 10 years down the road, I'm getting the same $6,000 from that pension fund. But inflation, what could I do with that $6,000 10 years down the road? So I am actually losing the value of the dollar, keeps reducing over time. And the extent to which inflation rate is moving, if inflation rate is high in the economy, it means my dollar is losing more and more of its purchasing power, the ability to buy goods and services. So what you could buy now with $100, a year from now, you will be able to buy less goods and services. And are there new expenses that I may have to face in terms of medical or travel or household maintenance costs? So these are some of the factors that a person needs in terms of your funding your retirement. So it's critically important that you have money set aside. Because when we come now to the financing needs, basically there are just two: a need for cash and a need for income. A need for cash to take care of unexpected major expenses that I may have. If I don't have cash set aside to be able to deal with that, then I will have a problem. And then my income needs, because let's take a typical example. Let me use me as an example. I have a situation since 2023. I've had some, my spouse has had some serious medical challenges that warranted and necessitated cash lump sum payments to be made. Along with, because of those medical challenges, certain medical costs have now increased on a monthly basis. So I need income on an ongoing basis to be able to meet this increased cost. So basically, as we save towards our retirement, these are the basic funding needs. You will have a need for cash, a need for income. So let's take a look now at sources of retirement income. And as I go through this, I want you to take the time to internalize and ask yourself, do I have some of these things that Mr. Calendar is sharing? And where am I in relation to it? So let's talk about it. Do I have a company pension plan for my current or past employment? And if I do, am I, with most company pension plans, it's fixed by the amount that you can contribute to and that the country may be contributing to. And generally in Trinidad, we have two basic types of plans and from a company. Either what is referred to as a defined benefit contribution plan, defined benefit pension plan, sorry, or a defined contribution pension plan. So what's the difference between the two? Essentially, with the first one, a defined benefit, your final benefit is determined upon your years of service and generally your last income or your income over the average income over the last year or last 3 years. So if with a plan like that, you can make certain projections to get an idea of what your final retirement benefit will look like. With the other one, which is the contribution plan, that is dependent upon performance of the plan. Now, in the first option, if the plan is not performing well at a defined benefit, the onus lies on the company to meet any shortfall with the plan. With the defined contribution aspect, there is no shortfall to be met by the company. So in other words, the employee carries the full burden of what is going to accumulate thereafter. Do I have a personal annuity payment that I can expect from anywhere? Am I now contributing to a personal annuity for myself? Do I have rental income? Or is it that part of my retirement plan, remember we talked about retirement plan earlier, is that I will seek to borrow money and I will remodel my home, or I will purchase a second property that will generate rental income. Or I remodel my home, I expect the children will be gone by then, and I could put on a piece in the back or at the side to give me some rental income. What about investment income from investment that you would make. So by being a member of the credit union, and I know the credit union pays dividends each year after their AGM, so that will be a source of income to you. I believe with the credit union, the member may have the option of having all of the dividends go and credited to their shares, or alternatively have some aspect of it either in cash or a combination of the two. Do I have, if I am in business, can I expect to live on the profits from the business to provide me with income? And what about Social Security, NIS, and old age pension? Only 2 weeks ago, I was saying to a client of mine, she said, Keith, when I turn 60, I will qualify for old age pension, right? And I said, really? I said, you have to pass a means test first. So I asked her, I said, you have a pension that you expect to get from your employment, right? She said, yes. I said, and you also expect to get NIS pension, right? She said, yes. And I said that you also have a pension plan, personal pension plan that you have. She said, yes. I said, so, but those different streams of income, you think you can satisfy a means test? Where you have to show the government you have no income and they'll feel sorry and give you a pension? She said, but I know people doing it. I said, well, okay, but if you are prepared to break the law, that's entirely up to you. But what I'm saying, it is not automatic that because you work for years, that when you turn 65, that you will get old age pension. She was of the view that once she turned 65, she was entitled to old age pension. So what about savings? Withdrawal from my savings. Again, if you have money accumulated, that could provide a source of income. So just take a look at this table now. Excuse me. And I put this here, and I want you to stop and ask yourself, how many legs are on my retirement stool? This is the retirement stool. If I have one leg on my stool, then obviously I cannot sit comfortable on a one-legged stool. If I have two legs representing two sources of income only, I also cannot sit comfortable on my stool. So I need at least three sources of income to be able to sit on my retirement stool. And the more legs that I have in my stool, the more comfortable I will be. I could afford to lie down. So let's take a look now. As I conclude, we just want to go through this with you. Retirement finances should not be a matter of chance. Rather, it should be a matter of choice. The decision on whether you live as an old man or an old woman or old gentleman or old lady lies largely with you. In every young person, there is an old one. The young person generates the income, but the old person spends it. What the old person gets to spend is determined by what the young person saves and invests. The old person is inside of you. So plan properly or he or she will curse you if you don't. So I asked the question, would your retirement look like this? Sitting down in the sunset on an evening, watching the sun go down, sipping your favorite beverage, hopefully with your spouse, and watching the waves roll by? Or would it look like this? Sitting down to count every cent because of lack of proper planning. Now, nobody wants to be like this little lady. So let's crumple up that and get rid of it. Thank you, ladies and gentlemen. And I extend my appreciation once again to Tannins Credit Union, the Education Committee, the Board of Directors and members for giving me the opportunity to present this evening. And at this point in time, I want to take my flight out of here and answer questions. So, Francis, floor is open. Over to you.
Yes, good evening, guys. So Kita is open for questions for Q&A. I know we have a lot of points that you raised there that is very vital to your future and your future planning for your retirement, especially financial independence, because we don't want to be counting pennies when we get older. So feel free, the floor is open. Please free to join and ask any questions if you need to, please.
A participant shy.
Well, probably I could just start the ball rolling, just take
Go
everybody.
ahead. Go ahead.
So I know you touched on health expenses. I know there are a lot of challenges to income when someone is not well. What do you think are some of the factors we could help to mitigate against something like the health expense?
Okay. The most effective medium tool to mitigate against risk is insurance. The extent to which you have health insurance. Now, again, people on this platform may work in different establishments. So if your employer has a health plan, and don't miss up on the opportunity to be a member of that health plan. And if by chance, even if you have to exit the plan, maybe you change employer to go to somewhere else. Most group health plan offers a 30-day grace where you can convert from being a member of the group to an individual. So even if you should change employment and you go on your own or you go into business, you can still get insurance coverage and not have to take out new coverage. So that's one. So you have health insurance because health insurance takes a chunk and the healthcare cost has been increasing steadily in this country. You can also have the extent to which you have critical illness coverage to take care should I succumb to a critical illness or my spouse succumb to a critical illness and we are both covered, then under a critical illness plan, you will get a lump sum of money to be able to take care of those cash needs. You remember I talked about cash needs earlier? Those cash needs then can pop up. So making sure that you have health insurance coverage, critical illness insurance coverage are vital. And of course, life insurance always have its place in the event that the member should pass away after a prolonged period of illness, that if there was a mortgage between the two individuals, that there is a lump sum of money that is going to come to possibly liquidate the mortgage so that the surviving spouse is not burdened with the responsibility. Because picture for a moment, husband and wife, two children, they are living a particular lifestyle. It is the joint income of both individuals is giving that household the lifestyle they enjoy. When that income is disrupted, either by way of sickness or death or disability, it is the members of the household that suffers. So to answer your question, Francis, having health insurance coverage, critical illness coverage, insurance coverage, life, and when it comes to property, making sure that your property is adequately insured. Because in Trinidad, there's what we have, well, all over, you have what is called an average clause in your contract. What does that mean? It's simply if more than 80% of the value of your property is underinsured, then if there is a loss, the company will pay you a portion of that loss. For instance, let's say your home is valued $2 million, but you have your home insured for $1 million. Your home is insured for 50% of its true value. So there is a hurricane, your roof is blown off, or there are some sort of damages, unfortunately. And to repair that home costs $200,000 of damages. Because the home is insured for only 50% of its value, the insurance company will only reimburse you up to 50% of the cost of that or to repair that home of 200,000. So you will get only $100,000. And you will now have to find the next $100,000 out of your savings or have to go and borrow to be able to finish your repairs. So insurance is the cheapest tool that you can use to be able to mitigate against financial risk.
Understand. And I know we have also our GenMed at our side too, which provides a
Mhm.
lot of services for the medical side where our members can join and subscribe to. It is a fantastic service as well as I know the credit union is always here to support, even if the event of unfortunate incidences as well. Some questions came up too as well, Keith.
Oh,
Where locally can one find a financial product or service offering 8% average return over several decades, as used in your twins example at the start of your
right.
presentation?
Okay. I've answered that question. As I said in that when I did that, it was just an illustration to highlight the importance of starting early and to show the differential of one person who started early and the other one who started late. So you may not be able to get 8% on a particular product, but surely from a portfolio point of view, it's very possible to have more than 8% over a period of time,
Yeah.
depending upon how your financial portfolio is structured.
Yes, I believe if you structure your portfolio, you have
That's right.
your long
That's
term,
right.
medium, and short term,
Long, medium, and long-term investments.
right? And that what will help. I know
Yeah.
our Golden Star always offers a very good return as well. One of the other questions we have here is from what you have observed with your clients. Would you say that the money spent paying off a mortgage pre-retirement here should be now saved or budgeted towards term medical care and expenses? That is, the previous money spent on a mortgage should not be spent enjoying life.
Repeat that again for me, Francis. I didn't think I get the first part of it clearly.
From what you observed with your clients, would
Uh-huh.
you say that the money spent paying off a mortgage and pre-retirement years should be now saved on a budgeted towards term medical care and expenses? That is, the
Okay.
previous money spent on the mortgage should not be spent on enjoying life. Is that what that's what they are asking?
Okay. It depends on, I like that tell it's a sort of chicken and egg situation, which comes first. For some individuals, they don't like to carry debts for long periods of time. And if you are if the person who asked the question is the type of person who don't like to carry debts for a long period of time, and rather than carry a mortgage for 30 years, they will have no problem in making these sacrifices now to carry that mortgage for a 20-year period by paying extra because they feel if I pay extra now, one, I will be paying less interest over time. I will have the comfort of knowing that I would have paid off my home ahead of time. And and I can now start to look at other things that I wanted to do to be able to go towards my retirement. Now, again, some individuals might say, all right, I want to leave the 30 years rather than pay this extra amount. I have no problem paying the interest, but I want to save towards the retirement to be able to make sure that I achieve my retirement goals. So again, it's very situational because different people have different way of thinking. For instance, I have a client who for years I was saying to her, she saves primarily wonderful in credit union, bank, and a few mutual funds. And I have kept saying to her, you need to invest in money that has the potential to outstrip inflation because that is the extent to which your money will really grow. If your entire portfolio is just being able to satisfy the rate of growth of inflation or falls below, then you will have a problem in the years ahead. She has now retired, and what I was saying to her more than 25 years ago, she's now starting to experience it. So I don't know if I have adequately addressed the question, but that's how I see it from my perspective. And again, different individuals, based upon what they perceive as important to them, and it's always, I have always gone along what an individual perceives to be important to them, to work with them to help them realize that particular goal.
Yes, I understand what you mean. That's really informative. I have a next question from Camille Samuel.
Yeah.
She's asking a very good question, very short but very effective one. Where would you place your cash, in an annuity or the stock exchange?
Okay. So that's a very good question. All right. And I tell individuals there is no one investment that is the best investment. So the stock exchange carries a different level of risk as against an annuity. So let me explain that. With an annuity, you pay an annuity into an insurance company. The insurance company, you are not the only person they're paying other people. So the investment put individuals at the insurance company or bank, as the case may be, or unit trust, as the case may be, but whatever financial institution, they now take charge of investing your money for you to seek to get the best return for you. Now they are using their resources. So by using their resources to do that for you, they charge a fee. So that whatever return you get is not the true value of the investment over time. On the other hand, if you're going on the stock exchange, you are taking all the risks. And with risk, there's a relationship between risk and return, where we say the lower the risk, the lower the return, the higher the risk, the higher the return. So to answer this person's question, it is not which one is better or the other. A matter of fact, if you have it in combination where you have an annuity and you have stocks investments, and you are able to manage both because stocks, because you are taking a greater risk, has the potential to give you a greater return over time that you will get on an annuity over time. But you are taking more risk. It also have the potential to be giving you income by way of dividends that you can use for reinvestment. And you decide how you're going to be using that income, whether I want to reinvest this dividend that I earn back into more stocks to catapult my earnings and savings down the road, or do I want to use it for other things, to put it into an annuity or put it in a fund, put it in a credit union because I want to do some addition to my home to generate some rental income to get my added income stream down the road. Because I'm going back to those sources of income and I'm going back to the retirement objective. What are the objectives? What are the things that you want to do? Do you want to be in a situation when you retire that I only have two forms of income or only three forms of income? Or do I want to be in a situation where I have multiple streams of income? Because the more streams of income that you have, representative of those legs that I had on that source of income table, the more comfortable you will be in your retirement. So I hope I would have answered that person's question.
I know you said earlier that the trade-off in your current lifestyle to your retirement lifestyle is what you were addressing there too. We're
Yes.
looking. We don't want a two-legged table. We want an eight-leg table. We want a spider table, so we can at least enjoy the fruits of the labor after. So we know we have to put you the risk and the reward, but also the sacrifice too, and that will help us make the difference. I also have another question, which is another short but sweet question. What is your opinion on utilizing the equity on your home or mortgage for investment purposes?
Okay. That's a very good question.
Yeah,
And
very.
yeah, um, yes, I talk about individuals who are house rich but cash poor. So if your home now have equity in it, and you have, let's say, let me use it as an example. Some years ago, I approached a bank. A friend told me of an investment opportunity. I approached the bank and I said, look, I want to get involved in this investment. This is my home. This is the equity in it. I want to get a loan. I took the loan to purchase the investment. So what I did going that way, as I was paying, remember I talk about the net worth over time? Because you are paying each year, you are repaying the banker or the credit union, the loan, your equity and your other investments are increasing. So I experienced where what I was putting out as against what was coming in by this other investment was to my benefit. Hence the reason why I was so adamant to get into that investment and to go the route of using my equity. So I was able now to build a greater capital base than I had before by using the equity that I had.
Understood. No, there's a lot. It's a short one, but there's a lot to swallow. I have another question here. What is the average inflation rate of TNT?
Uh, Inflation might be averaging around 4%. I think in the last, or 3 point something percent in the last figure I think came out. I did not, in preparation for this, did not look at um, the last set of inflation figures. But in Trinidad, we have had a fairly stable inflationary environment relative to what other countries have experienced. So if we were to look back, and I did an exercise like that a couple of years ago, look back at an inflation rate over a 25-year period. Over a 25-year period in Trinidad and Tobago, I did that exercise about 4 years ago. We were averaging under 4% inflation rate over a 25-year period. So if you use that as a yardstick, past events is no predictor of future events. So in planning for the future, I always prefer to use a rate, not the existing rate or the past rate, but a rate marginally greater than what exists now, because no one knows the future. So if I am doing an exercise now to assess, I will generally use like a 5% inflation rate in terms of being able to project what will the value of money in the future or the value of earnings in the future, as the case may be. So say for instance, let me give an example. If it is that you need now, you can live now, a household living comfortable on $15,000 now or $10,000 now. And at a projected rate of inflation of 5%, if you're projecting what kind of income that you want to have. And as I said earlier, generally a person require between 70 to 80% of pre-retirement income as income in retirement. So I'm going to use an individual who is working for $10,000 now. So that individual who's working for $10,000 now, who says, "Keith, I feel I can live right now comfortable on $7,000. If I retire today, I can live comfortable on $7,000. Then I will look at it and we will look at, okay, so we take 7,000 now at a rate of inflation of, let's say, 5%. And the person, based upon their retirement preparation age, we will say, okay, if you have going towards, you have the next 20 more years, then we future value what is 7,000 will be in the future. That may come up to be 14, 15,000. And on that basis, that is going to tell, say, what is the level of income that you will need to have when you retire. And then we will look at what are the sources that you have now that will potentially give you that income in the future. And that's why you look at if you have a company pension plan, you look at what it is. If you have an annuity, you look at what it is. If you have other investments, you look at what it is. Because what we want to identify is if there's a gap in what I desire in the future and what will eventually happen in the future. And if I can reasonably predict that today, then I know I have a gap. And if I have a gap, I have to take action to close the gap. And that's what I talk about, making adjustments to your current lifestyle to achieve your future retirement lifestyle. And sometimes it calls for making a very hard personal decisions to say, here what? You see this money, this thing now, when I do my budget, I do my personal financial statements, and if I'm not pleased with what I am seeing, it ain't going to change unless you change it. Because one of the things I always say to individuals, there's an expression I heard many years ago. People don't have a money problem. The problem that we have as individuals are priority problems. What's our priority? And in the example that I use with James Joe and John Doe, James had decided his priority was to save his money. But his brother John, his priority was to fret and have a good time. So when we re-examine our priorities, determine what action we should take to correct it. Because if we continue doing the same thing over and over and over, we will get the same results. So I am really hopeful. That's why I took the time to, and I'm really hopeful that individuals attending this webinar would really stop and take a critical look at their own personal situation and take action as necessary. Because for as long as you are alive, you will grow old. For as long as you are alive, when you grow old, you will have your employer may not see your usefulness in the workplace, or you yourself may not see the usefulness in the workplace. Leisure becomes more important to you than working. And some people are forced out because of health circumstances.
Right, right. Very good, very good. I appreciate those nuggets. one person added that that they have a concern that the published inflation rate is not accurate. Would you share a concern like that?
The published inflation rate meaning what CSO puts out or the central bank puts out.
Yes, correct.
Right. Okay. In Trinidad, that has always been a conversation that inflation rates are not accurate. But what other medium do we have?
Sure.
We only have the Central Statistical Office, whose responsibility it is to compile the data and present it, and the central bank. We don't have the level of sophistication that other countries may have. So we have no choice but to rely on the statistics that are presented by the authorities responsible for presenting it to us. Because
Uh,
if we don't, where else will we get it?
Understood. I guess we all will try to mitigate against that by pushing our income or our saved income or investment income a little higher, just to cater
Mhm.
for those false positives or false negatives, if you want to call it that.
Right, right. Hence the reason why I said I will not use a 4% or a 3%. I
Always try.
always, if I or in making projection, I would prefer to use something higher than what it is put outside there because it is better. I aim higher and the reality comes lower, then I'm better off. Than I aim low, the reality is higher, then I'll be worse off.
Okay, okay, makes sense. I've just a part B on someone who asked the question earlier. Where would you place your cash in an annuity or a stock market? And he was asking to know what, if you care to share what that investment is, where you
Okay,
could put your that money.
all right. If I'm an individual, I want to deal to the annuity. If an individual put their money in in an annuity, they have given the responsibility of investing their money for them to the particular financial institution. So the ability or inability of the financial institution to grow their wealth for them is what they have handed them over to. When an individual goes to the stock market, they are taking on the responsibility themselves in seeing about their portfolio. Save and accept if you have that level of wealth that you now have a wealth manager, a personal wealth manager to manage your portfolio for you. And even if you have a personal wealth manager to manage your financial portfolio for you will have to pay that person an income, a fee for managing it for you. So going to the stock exchange, what the stock exchange has historically been able to do and has proven all over that with the passage of time, you tend to get a better return than that any other investment that you could have made. Maybe say what may challenge that sequence might be real estate because you might purchase a particular property and that property would have appreciated significantly in value over the years. I have seen people purchase land and in a year's time, the land double in value again because of things that might have happened. They may have purchased it at the right time. So investing in a stock exchange, one, is more risky. But however, it does two things. It has the potential to give you capital appreciation on your investment. And just as it has the potential to give you capital appreciation, it also have the potential to give you capital depreciation, which you have to be mindful of. So you have to know, one, what should be my stop loss level, or what should be the level when I make enough that I pull my money out. You have to decide that. And it depends on the kind of investor you are that will determine that. And that goes into a whole different kind of conversation, Francis, in terms of investment,
I
right?
know.
Um, but
There's 20
but with
steps.
the so the and apart from a capital appreciation, you also get dividends, which will provide you with an income. So you are getting both capital appreciation and income. Whereas with the annuity, the financial company getting the same thing, but they're taking the part out of it. And when you purchase that now, depending upon what is the annuity rates, to now pay you a monthly stream of income at your chosen retirement age. But the good thing about it is that you're getting a payment for life. So an annuity is a financial tool that you can never outlive. Most plans, they will have either a 5-year guarantee period, a 10-year, they carry some guarantee period. And what does the guarantee period means? It simply means that once I start to receive income, remember, because right, right now, to save towards my retirement, I'm saving, so I'm accumulating funds over the years. When I have retired, it's now time to take me to the distribution phase where I'm now receiving the proceeds of my hard-earned earnings over the years. And I want to make sure that this income is paid to me for some guarantee period. So in the event that I should die before I happen to enjoy all of it, then my spouse or my beneficiary or my estate, as the case may be, will get the rest. So if I have a 10-year guarantee, and after 1 year, I pass away, then payment will continue to be paid to my beneficiary for 9 more years. Because again, my income from retirement was what I had used as part of my overall household plan. So when that is now cut off, my spouse and maybe grandchildren at that time could have a problem. But now, if I outlive the 10-year period, and as we saw with life expectancy, and I hit age 100, the insurance company pays me until I am 100 years of age. So it's really a gamble, but quote unquote, of how long I will live and how long I really live.
All right, I have a quick question for you. What is
Go
the
ahead.
percentage tax paid on retirement income from annuities? It's about the time value of money.
Right. The tax, if we're talking taxation, that depends on that. I talk about public policy. Right now, again, every working individual or every national is entitled to 90% as a personal allowance. So if your total income, retirement income, is less than 90,000, meaning I have a pension from work, and let's say my pension from work is getting a $5,000 pension from work, and that's $60,000 for the year. And on my annuity, I'm getting $3,000, or let's say $2,000 on my annuity a month. That is $7,000. 712 is 84. So my $84,000 NIB pension is not included. So my $84,000 falls below the threshold at $90,000. So it means I will pay no taxes on my monthly income. So my pension from my work will not be taxed. My annuity will not be taxed. And when my annuity matures, I have choices. I can choose to take 25% of the accumulated amount as a tax-free lump sum. And the remaining 75% is what is used and applied to pay me a pension for the rest of my life.
All right, great. I have a couple more questions. They're still coming in, which is great.
Mhm.
Which is better to invest in an annuity or an endowment plan?
Okay, good question. $1 of tax earned is $1 saved. I repeat that statement. $1 of tax earned is $1 saved. With an endowment plan, I am paying towards my endowment plan with after-tax dollars. So I enjoy no tax savings. If I take that same money, and I'm gonna call numbers, let's say $500. I'm paying $500 to every month an endowment plan. And that is being paid with after-tax dollars. If I decided, here what? Let me put this $500 towards an annuity. And by doing that, I now enjoy a tax break of 25% of that $500. 25% of $500 work out to be $125. So the true value of $500 in a tax environment is $625. So I could pay my $500 towards my annuity, and as I do that, my tax liability reduces on a monthly basis by $125. I can now take this $125 and reinvest that elsewhere. Maybe put it in the endowment. So my $500 now change in value from $500 to a $625 investment. Now, which is going to give you more money over time? $500 or $625?
Understood. All right. I have another question here coming in again.
Before I answer that question, that other question, the other significant advantage of the annuity, it is a registered. Once it is a registered, because you have unregistered pension plans, and you have registered pension plans. So in the example that I cited, it must be a registered pension plan that allows you to claim taxes on it. All right. Now, if it is that the individual, as the example I cite, goes that way, then they have two different types of investments. An endowment has no shield. It has no protection. So if someone sues you, they can go after your money that you have in your endowment. But your annuity is protected in a trust. They can't come after that because the only person to receive money out of that is you, nobody else. So from planning point of view, I always ask the person, what do you want? Do you want to make sure that you always have a guaranteed income, no matter what happens, that you have a guaranteed income? Or do you want to take chance? Let me get the next question. Go ahead, Francis.
This one is a question, a very good question as well. Is it ever too late to prepare for retirement?
Okay. The best time, that a Chinese proverbs that says, the best time to plant a tree was 20 years ago. The next best time is now. So I will say to that individual, if you have not started in the past, now the next best time for you to do it.
Right.
Please make a start. Make a start. And it's never too late. I recall I was around 39 years at the time. And I was talking to a neighbor of mine. And he told me he started to plan his retirement since he was 29 years of age. At that age, I had no thought in my mind about planning retirement. But when I walk away from that conversation, I say, but what Foreman saying is true. He has since passed away, God bless his soul. What Foreman saying is true. And I made a decision that I would make an effort to start a plan for my retirement in a purposeful way. And I am really hoping that the information that came forth to you all today will really drive you in the direction of taking a critical look at your situation. For those who have already started, God bless you. Keep going. I hope I know the credit union offer those kind of financial counseling services to its members. Make use of it. Avail yourself to as many seminars and conferences, read articles dealing with finance and money so that you become more literate and be able to take better charge of your financial situation. Right?
All right.
Yes, Francis, go ahead.
All right. I just have one question that a member asked. What is the interest rate for the Golden Star? Which is something for me to answer.
Yeah.
Keith. It says 2% semi-annually on their average closing balance. So your average closing balance, you have 2% is paid out semi-annually. So which again is a good investment considering the climate outside there. So
Yeah.
again, give us a lion's share of your financial needs and we will support you.
So Francis, could I ask, what is the Golden Star? Just give me an idea of the product.
Golden Star is our savings account if you want to for better, but that it is our savings account. So you
Okay.
can also purchase shares, which is what we normally do when we invest in the credit union, but we also have a savings option where you can save
Right.
and you get a return of 2% semi-annually. So it's actually a very good investment.
Well, I could say to you and persons on this platform, you're not getting 2% in a bank. A matter of
Definitely not.
fact, a lot of the money market accounts, and I gather based upon what you have said, if you're talking about a savings account, well, excuse me, if the individual want to come and they take money, they can take it, right, Francis?
Okay.
Right. So, in that type of investment, the environment now at most paying 1 point something percent. My one of my brokers sent me information this week. Their money market account paid. Let me just get some more. Yeah, sorry about that. Their money market account was paying 1.3%. And I can say to you with confidence that 2% is very good, actually, on that type of instrument. Of course, again, I spoke about the risk return. There isn't much risk associated with that investment. So the return is a lower amount. If there was more risk associated with the investment, the expected return would have been higher.
Right.
So the question that one of the listeners asked about the stock, because I'm going on a stock exchange, I'm taking more risk. So I have the potential for more return. But it's important that in your overall financial portfolio, you have investments that have the potential to give you growth and income.
Okay. So Keith, I would like to thank you for your time, your knowledge, and you sharing some tips that we could implement to ensure our financial independence. Because I know it is quite important to balance your life in this stage right now. We younger ones, we need to make sure and put aside for the future and make sure we plan for retirement. So that's like I said, the 8 pillars, or we have pillars to support our table. The more pillars we have, the more stable it is. So I encourage us all to invest. And like I keep saying over and over, make the credit union your foremost option of savings and investment. So I will also say for those who wish to listen again to today's session, the recording will be uploaded in the library session section of the Secure website, so you can access it at any time. We have planned a series of webinars for the Credit Union Month, and we'll have a session on wills and estate planning to do or not to do, This session will take place next Wednesday, 25th of October from 5:30 to 7:30. You should have already received the email invitation for it. So you could go back in your emails and register to attend. Reminder emails will also be sent to you, so you can definitely look out for them. Guys, that is very important. Wills and estate planning is extremely important for our financial well-being as well. And then we have a webinar at the end of the month, at the end of our credit union month, which will be on Tuesday, the 31st of October, again with Keith, which will be, he'll be presenting our members who are already retired. And the topic will be retirement planning, navigating through our golden years. If you know any of our SECU members who are already in retirement, your parents, friends, etc., please inform them so we can participate on the webinar, as registration is currently open and is free. So, ladies and gentlemen, we have now come to our end of the evening's webinar, and thanks again for joining us. And again, please make your credit union your destination for your financial needs. Give us a lion's share of your business. We will assist. Yeah, enjoy your dinner and have a restful night and a productive day tomorrow, guys. Okay, thanks again.
You're welcome. Thanks a lot for having me. Much appreciated.